This episode was sponsored by Property, the leading real estate platform for all real estate transactions with a comprehensive ecosystem. They combine highly trained experts with the latest technologies on an intelligent platform to provide clients, brokers, and service partners with risk-free, flexible, and simplified services. Learn more at property.com/ch. That's property with an i.com/ch. What made you keep going in that very moment where I said, now we even invest more? We don't just invest more time and more energy, but also more of your own personal money or even family money into the company.
Tequila. really conviction.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. If you enjoy listening to our show, make sure to follow the podcast and leave a rating. And now, here's your host, Sylvan.
Joel, Ben, and very well welcome to the Swisspreneur Show. It's a pleasure to have you as guest today.
Thank you. Welcome.
Pleasure to be here, really.
You're the co-founders of VEI, the most advanced motion tracking technology for fitness, but also for physical therapy. Before we start talking about the journey and how you built and exited the company, Joel, you studied robotics at ETH, and Ben, you studied business at HSG. Joel, how did the two of you actually meet? How did all of this start?
We were actually living in the same apartment building here in Zurich, and we definitely did come from two very different directions, and I think we were at very different points in life too. We met over one or two house parties, I think it was, and we had some chit-chat about what we do. But the decisive moment was when I got home after one of our first app releases back in the days, and it was like 10 p.m. summer night. I was really excited. I had like so much happiness and joy in me. And I met Ben at the leather boxes. He also came from work, but his mood was very different from mine. I think he was wearing a suit. He rode his bike back home at 10 p.m. and he was sweaty and he definitely was in a bad mood. And I said jokingly, "Hey Ben, what's up?" And he was like, "Well, I hate my job." And I was like, "Do you need a new one?" And totally as a joke, just because I was feeling so good. And Ben looked at me very seriously and said, "Yeah, let's talk." And within 2 weeks, I think we met with the whole rest of the team and we figured we actually are missing exactly somebody with Ben's experience to get this thing really off the ground. It seemed a perfect match.
What were you working on back then, Ben, that got you so frustrated that you wanted to switch as soon as possible?
Ooh, can I say that? Yeah, sure. Tax reporting for funds. I was working at EY during my master's in the tax department, and it was okay, but really just okay. And after close to a year working there, I was really fed up and I swore with like 18, 19 to myself that I don't want to work for money, but for purpose. Then after a year saving, we both, I think, lived extremely on a low budget. I was able to save some money, working 80%. But yeah, then I was like, no, fuck it. I want to do something in fitness. I want to do something with smart people. And then there was a match, yeah.
Off you went.
I think I had a killer pitch as well. I told him that the hours are at least the same. The risk is much higher. There's zero security and you're not getting paid. And he was like, hell yeah, I want that.
It's all about the impact and the fun along the journey that got you attracted to that. And Joel, before you actually started VEI, you were also a professional volleyball player. And I just wonder, people were actually asking you for fitness advice. They came to you and thought, oh, maybe you can help me. This guy looks fit. He knows what he's doing. How did that eventually lead to the start of your company?
Yeah, I mean, as a professional volleyball player, I did spend a lot of time in the gym. I think I I was one of the very few people who have the privilege to work out with an actual professional personal coach who tells you in depth how exercises work, how movements work together, how to properly execute them, but also the reason behind, right? A deeper understanding of how movements properly should work. And yeah, I wasn't the tallest volleyball player. Usually I was one of the smallest ones on court, so I had to make up with a lot of jump height. And so I did really spend a lot of hours at the gym. And in the last 2 years when I was practicing at Neffels, I did that on my own in Zurich. And yeah, usually I did see a lot of other people working out with free weights, and very often, despite it being higher end gym, it was clear that they did not have proper instructions, and it's very easy that you can injure yourself or create some long-term damages to your body. And I tried to help them. Some were very receptive, others were like, who are you, right? That was actually like one of the first hypotheses we tested. As soon as it's coming from an app, from like an AI or something like that, people trust it. People tended to not believe that without my credentials that I knew better than them, but they immediately believed that this app that they did know nothing about would know better than them. So yeah, that's definitely where it was coming from. I started way during my last professional year. So I basically did practice in the morning, then worked on the digital fitness coach in between practices and practiced again in the evening. And luckily I was able to also kind of finance the first year of bootstrapping the startup like this.
Amazing. Great start story. And Ben, you were working in the traditional corporate world, so to speak. You studied at Hask, and I wonder, before you had this encounter that we just heard about before, did you ever think about becoming an entrepreneur one day?
Yeah, definitely. I worked also in a startup close to my job there before EY, where I got to know this whole thing, but also the challenges with it, the salary level, the hours, and also raising capital was their topic. I was there the founders associate or whatever you want to call it. Yeah, and definitely gave me that exposure, some insights, but doing it as a founder is a whole completely different game again. Yeah, I think that was the first one. But again, I had this really early on in me, not working for money, but working for something that you actually like. I think a job, you shouldn't work, in my perspective and for my life. I think you should use your hours during the day or during the time you want to work in something that you actually like. A job is not just something that allows you to enjoy the weekends, at least again for me, but really something that should have somewhat of a bigger meaning, some impact.
Definitely. So let's go to 2018. That was the founding year of Vey, and take us back there, Joel. What were the early days like, from the fitness app that helped people to build more trust into coaching programs, etc.? How do you take it from there to then eventually build the company? Let's start with the co-founders, because there were different constellations in the early days already.
Yeah, 100%. So the founder story of Vey is quite a roller coaster, I'd say. When I met my two very first co-founders, or teammates along the way, the whole thing was spun out of a university project that actually pursued some kind of t-shirt with sensors. I was fresh out of my master's. I had worked on the vision technology, and I was like, because I saw the t-shirt was a huge hassle and distribution and everything, it was like, can we do it without the t-shirt, with just a sensor that's available on phones and laptops and whatnot? They were very receptive to that, but from the student projects, only one guy was willing to pursue it, Alex. At Startup Speed Dating, we met our third original teammate, Casper, who was wild young guy, still in his bachelor's, but did a lot of side projects on digital marketing and branding, a lot of content creation. So that fit very well. Alex had kind of like the business side. I was more the techie, and Casper would take care of the whole marketing and branding and content creation for the app. Along the way, within the first year, so we were working together for around 12 months before we even got incorporated as a business. There was this last professional volleyball season that I mentioned before. It was like I would definitely not call it a hobby project because it took a lot of time, but everybody still had something on the side. They both had their studies. I had volleyball, but we were eager to figure out if this could lead somewhere. So when we had early, very, very small successes, our first users, some power users that would really be thrilled by what the app was delivering to them, we felt great. We were onto something. So, and I realized we need more manpower on the development side. So I brought in an old high school friend of mine, Patricio, who was at the time also still studying at ETH, computer sciences, and he seemed the perfect guy. He also had a professional sports background. We got along great. He brought in the technical expertise. He was already working as a software engineer in various companies next to his studies. So he really brought in some deeper technical expertise. So the four of us pushed it further. I think we went up into open beta. So we had the app on the store. We didn't really have people really pay for it, although we did some pre-sales to figure out if people are also willing to actually pay. And then we wanted to get incorporated. And then the first surprise happened when Alex, the original founder from the student team, he decided to quit because I think it was mostly a bit of cold feet of really putting in the money to incorporate a company, to really commit to this for what we knew would likely be 7 to 8 to 10 years or something. It's turned out to be much faster, right, in the end, but he wanted to quit. But also because we pushed it for his opinion too much into a lifestyle direction. So from the beginning, we always knew this technology has huge value for fitness, but also for physical therapy. So within this first year, we learned that for the medical case, for physical therapy, we would need to have a lot of certifications. We would need to have a lot of clinical validation, and we might have a much easier entry within the fitness space where everything is much less regulated. And I think that did not work perfectly with his vision at the time. So we lost our guy with an economics background. We were still super passionate about the project. So we said, no matter what, we're going to incorporate this company. We're going to push. And then Ben happened. So we brought in Ben as 100% part of the founder team. So we never treated him as anything else than a founder. And I think he proved that very much along the way. But he got in shortly after we incorporated the company.
Amazing. And I think that's very natural that you have these transitions, that people might start a project, but then eventually leave for whatever reasons. I wonder, when you joined, Ben, how did you handle the shares part? Because there has been some history with Alex leaving before incorporating. How did you go into this conversation of how should we split the shares?
Today, I would definitely do it differently. In the end, also, I started with less naturally than I had later on with the same team still. I had to prove myself a little bit. And as mentioned, we all were 23, 24, extremely young. We had no previous experience with founding a team and how do you do a share split? What are the responsibilities? What implications potentially does this have for, many things, also tax. So definitely there were some learnings. I tried to tell them, look, if you give me this amount of your company, I will prove my value over the next 3 years, and that's certainly more than this value. That's how the conversation started. Again, today, I probably would do it differently. I can right now not say how exactly, but I think it's extremely important that you don't discuss about ownership too much. Never, basically. I mean, do it once, but right, or twice, but right, if there's a problem. But certainly, I think that there should be a clear decision in the beginning such that everybody is happy and can move forward 100%. And for me, I mean, I think, if I remember correctly, this was also the discussion back then that if I prove my value, there will be more a little bit. And I don't think this is so healthy. Yeah.
So you then got more shares later down the road.
Yes, but also we have to consider that some people left the company. We basically had to restart the whole company again 1 year later, basically, where we also let go everybody except from one person. So there were various transition periods in various areas, definitely the team. Yeah. But again, what I would say for entrepreneurs out there, make this, maybe get help even for this, some experience. For the share split, I wouldn't care too much about if you have 2% more or less, but it should be fair and should be fair for the long term, because in the short term, it doesn't matter anyway, because in the well set up companies, there is vesting and then it doesn't matter anyway.
Yeah, true. I think that's a good learning. And also the whole roller coaster of people going in, going out, restarting the company up to a certain degree. I think we're going to talk about that in a second. Before we do so, I also want to talk to you, Ben, about the use cases. We heard from Joel, there has been the fitness use case. There also has been the physio use case. How did you decide about the right focus then? Because I know there was also a pivot along the way from B2C to B2B. Tell us more about how you sort of found the right application, the right market to play in.
So I think that's one thing we did right. Definitely. We tried a lot of things. As Joel mentioned, they tested very early on already the B2C use case, how that would, what reaction that would provoke from potential users. But then when we tried to raise capital from some of the top VCs, at least in Switzerland, we also realized, okay, they maybe have some different expectations, and it's certainly tough in Switzerland to raise marketing money. You have 3 languages, probably you're going to do in the 4th language in English. So just there's a lot of complexity for the B2C product in a competitive market such as fitness. So we had to take a step back, I think, correct me if I'm wrong, and really think about what we're good at. And in the end, that was the technology. There we were unique, there we were one at least, or the first mover with the first developed product. So we focused on this, and then also we talked with, I think for a longer time already, about health use cases with some insurance companies in Switzerland. And there seemed to be a little bit more demand for the technology, and really in the prevention case. This then also led to the first projects, even though, they were super interesting. One was in Germany where we tried to help luggage carriers. So the men mostly that carry around your luggage or lift in the airplane. Yeah, and that made sense, because if they don't have the correct form for 20, 30 years, Suva or somebody else will have to step in at like 50 or 60. So that really showed us there is a demand. There are nice, interesting application use cases, but really we had to try a lot of things, talk to many people. And that helped us to figure out, okay, where's the best use case, which was also for raising money. Yeah, okay, those are 2 separate, but it's definitely also easier in Switzerland to raise with a healthcare use case than with a B2C fitness. Yeah.
We also just don't have that many great examples here for B2C, so we don't understand it as well as B2B in that sense.
Yeah. So the health use case really then led also to some funding. We won some pitching contests, and that then I think gave us the boost, the confidence. And then really the fitness market, we always thought of the app fitness market, because that we knew a little bit because we wanted to launch a product there. But then also when we digged a little bit deeper, we learned about all the home fitness, the equipment players in the market, Technogym and the likes, and how they try to differentiate and how they could leverage such a technology. in the end, we didn't know about, really. Me even, I'm a fitness guy just like you. I know about the machines. I know even about some brands, but that we didn't really have on the radar. But I think it was just a lucky shot, the work we put in compiling those lists of potential clients, doing the outreach, then learning about the companies, what revenue they do and how they try to differentiate. And then COVID happened.
I see. Before we talk about that, Joel, this process that Ben just described, you had a great technology, but you were basically looking for the right use case for investors, but also for your company to build a suitable business. Why did you not give up along that process? What kept you going? Because that's very, very tough. You try over and over again, and then it just doesn't click yet. Maybe people, they say they like it, but they're not going to send you money. What kept you going despite all these challenges? Because it looks easy on paper, but I can imagine how hard that must have been this period to find the right market.
Yeah, I think it's just our founder team that's extremely stubborn and just not willing to give up on what we truly believed has a really high value in some setup, right? Mm-hmm. So we went with this B2C fitness app, and we still believe it might be at someday a great use case with great value to the customer. But still, like 5 years later, not one of the big fitness app providers has figured out just the right user experience where it's seamless to use and can seamlessly be integrated into your daily fitness routine. Yeah. So out of that necessity, we did that pivot. We kind of knew where the use cases would be. And luckily, we had a lot of inbound requests. And so we had those small successes. And it's always a roller coaster, but back then it felt like, okay, this is the highest high, right? And it's all, you have to look at everything in relation. Now, at the very end of the journey, that was white noise, right? The ups and downs back then were really just white noise, but back then it was the full magnitude of your emotions. So all the highs is really what kept us going, along with the resilience where we just were not willing to give up. But it was a tough ride. We had big setbacks on both customer side, on investment side. We almost ran out of money less than a year before we finally had the exit. So it was a few close calls where we also really had to sit together and have some real talk and decide, hey, is the passion still there? Are we willing to, because in the end, when that happened, we put in more money out of our own pocket. So we just basically, how if you incorporate a company, you can put in 50,000 at first. So we went back to our families and looked for the additional 50,000 so we could keep the team together that we had formed by then. But yeah, we had to have some real talks to figure out, is the fire still alive? Are we still willing to give that another shot after another shot after another shot, and eventually it paid out, luckily.
But in that moment, that was a very difficult conversation to have. What made you keep going in that very moment where I said, now we even invest more? We don't just invest more time and more energy, but also more of your own personal money or even family money into the company.
Tequila.
Really, really conviction, as well as a certain, what I said, stubbornness, or in the negative sense, or resilience in the positive, where we wanted to keep going. But also, I always felt very much responsible for our team. So we pulled together an amazing team that all started to work massively below their market salary, that also all believed in the vision, that put in not hours, but a lot of effort without ever counting hours in the early days. We promised them something. I sold them our vision, and I sold them the success down the road. That would probably have been my biggest failure if I couldn't keep that promise to the people that I got into the company because they believed in our vision.
You felt responsible for them. Yeah. Ben, you mentioned then COVID happened. That changed everything. How did you feel that you were achieving product market fit in a sense? Do you remember that moment when you say, I think now we really hit it after pivoting and trying many different routes?
I wouldn't say we hit product market fit, to be honest, ever, but it's hard to define that and whatever. Sure. If you remember 2020, when COVID hit, summer 2020 was the year that we really basically let everybody go. And there, I think, before we paid in the money, I think would have been the easiest time to, stop this project. But there was always some light at the end of the tunnel. You always had one project that, kept you alive, that gave us very little money, even Pneu or whatever the company was, even though they never paid the bill in the end or whatever.
Oh, man. But it was this light that you needed.
Yes, yeah. There was some demand. Yeah, that helped us. And again, then we started to win some competitions. Venture kick happens. It helped us a lot. Then the investor side came. And then really, now it makes sense if you look back. But the impact of COVID, it's all very logical if you understand our product and how it affects. If you cannot work out in a gym, you want to work out at home. Optimal case, especially in the winter. So you need some guidance at home. There our technology comes in. But who is winning? So the gyms are definitely losing, but they were not really. They could have been our customers, but they weren't. But really the home fitness equipment players. And at that time already we had 2 projects, I think, with the big ones, in the 2 biggest ones in the US, and we're talking basically with all the players. Mm-hmm. And yeah, that in the end, when that translated really into project revenue, but also ARR, that gave us that boost. COVID, in the end, the impact of COVID only happened 2021, I would say, because the companies also need to realize, okay, now there's a shift in consumer behavior, then there's a sales cycle that has to happen to, the management of the company also has to realize that, okay, our margins are higher, we have more money, do we want to, increase
so it's like a 6 to 12 month period until you then see the effect
from the effect on the consumers to really the effect in the startup level.
Yeah. If I may, I feel
that surprised me personally.
Yeah. I feel for a very small segment, we really found product market fit eventually, and I think that was in November 2020-ish. I remember, and a lot of came together. I think our product was all of a sudden exactly where this small customer segment needed it to be. Ben was working tirelessly on the business development side around how do we automate and optimize sales outreach. Mm-hmm. At the same time, we tried a lot on the investor pitch side. And I think all of these things kind of came together, luckily, at the same time in November 2020. And I remember Ben reaching out to really some of the biggest players in the field and getting half of the C-level members onto a call a week later, which is incredible if you think about it.
That's a strong sign, yeah.
And I think for that very small segment, we did have the product market fit. I remember another player, by then we also had competition, right? But the thing was, they got started at the beginning of COVID when we were already going over 2 years. Mm-hmm. So we had this advantage. They might have raised already more money because they were US based and everything. Yeah. And it seemed like a high conviction case where you can put in a couple of millions just to kickstart. But I remember another very big player who asked us on the first sales call, we saw 10 companies now like yours. Now, please tell us just why you guys are better. And we just gave them our usual demo. And the demo that worked really seamlessly and perfectly, they were like, okay, everybody else is still showing us some videos, pre-recorded and everything. Yours really, can we try this? And we were like, yes, here's the demo access. Go.
You were delivering, you were ready in that sense.
Yeah. So that's how they started the call. At the end of the call, they were like, okay, we want to work with you. That was really, they pretty much decided on the call. And I think that's really strong sign for the product market fit. Also that the outreach was good, that we found the right customer group with those fitness equipment manufacturers. And at the same time, we started pitching differently. We started pitching, at least in Switzerland, more the healthcare case, the physical therapy case. We were able to show early demos of that as well. Yeah, even though in the end, we were able to bootstrap the next months because all of a sudden revenue was coming in, but all of a sudden also it wasn't a problem to raise money anymore. So
it's always the chicken and egg problem, right?
It was definitely kind of crazy. And
what I really like about your story is that it also shows the importance of the timing. You kept going long enough until the timing was right. You cannot influence the timing, but due to the fact that you did not give up, that you wanted to make it work, you were there when the timing was right, or at least got better, right? Along that process, you then also raised money, more than $1 million. You also got other people on board, like Alex Ilic, for example, to really then, leverage what you were building, and that there now was momentum. When bringing in someone like Alex, sort of a serial entrepreneur, also very good standing in the ecosystem. First of all, how did that happen, Ben? How did you attract him to join you, and how did you incentivize him? Because he was not like working a full-time role at Way, but you still wanted to make sure he's incentivized to do good for the company.
Definitely. So the intro came from Dart Labs, Dart Ventures, from Sophie and Ariana. They also, I think they were the first investor or first institutional?
First investors, yeah. Alex was supposed to do tech due diligence on us for them.
Nice. I see.
Yeah. And then obviously he just exited the company, or also his years at Magic Leap. And then obviously that's the natural next step, that you help younger companies, young entrepreneurs, give them some guidance. Incentivation was really just he made a small ticket, but also we just gave him some shares. I think even phantom stock, I'm not sure. And I think that's the way how to do it. I think it's important that you really define what exactly do you expect from an advisor and for how long and whatever. But in the end, really, I think what was most valuable for us was some really strategic calls, how to approach a certain topic, a certain sales call. Even though he has a technical background, he knows exactly how to sell something or explain something. And secondly, was extremely helpful to mirror with him, sometimes in stressful times, in a weekly basis, what are the important topics, explain it quickly. Even though he maybe didn't say too much in those calls, sometimes it was just helpful to get it out, hear some initial response, and mostly it was, don't worry too much about this, or, so really the pragmatic response from him, I think, was, for me at least, helpful to calm a little bit down and see something in a different light. And I think every startup, to be honest, should have something like that.
Yeah. Especially one like ours, right? So to be very frank, we were all really greenhorns, and we were all the types who didn't want to learn from books, but rather make all the mistakes ourselves and learn from them. And I think so both Ben and I have done decent number of angel tickets so far, and it's really Alex brought in what we believe we can now bring into just this holistic view on anything. He wasn't like a specialist for just the technological part, but one week we would be looking at the sales pitch, the other week at how the technology is structured, then he would spend some time with the actual engineering team, and the next week we would optimize the pitch together. Another week he would bring in from his network that also we didn't have at the time as some interesting contact where we could further elaborate the health case. So it was really this, he has been on this journey. He has seen everything a little bit. So we were really able to learn from him, to not make all the mistakes along the way that he maybe has done before. And I think this is also, we or at least when I go to a startup, they're like, you had a computer vision startup, can you help us build like the tech stack? I'm like, no, because I would need to link you to one of the principal engineers to really look at that. But I'm more a jack of all trades. I've seen everything across the board in a startup, and I can always listen and tell you from experience how it was for us, maybe even without giving advice, because every case is different in the end.
Definitely. And I think that's so powerful to work with someone who walked that walk before, right? How do you incentivize someone like him? You know, you want to have that person, that entrepreneur, that experience on your team. You mentioned phantom stocks. What is the range that you should use for such an advisory role?
I mean, there are templates that give you numbers for this. Depends on, in the end, that's how I suggest how you should do the phantom or ESOP. In your company, you have a certain valuation. Let's say it's 10 million, and your advisor wants a salary 50K, let's say 1K per week for 2 hours or something.
Sure.
That's 500. That's a okay rate.
Yeah.
And then you just calculate that on that basis, and then you get the percentage. I would do it like this. You can follow it. You can set it higher. I don't really see the necessity, to be honest. And optimal case, people like Alex can incentivize themselves if they invest at an interesting early valuation stage. And then I think the advisory payment really should just cover the hours and not make it, additional responsibility, additional thing you have to do and not get paid.
Of course.
So I think the main incentivization should really come with an investment if the advisor has money, and most of those advisors do have money.
It's also skin in the game to prove.
Exactly.
I like
and
that.
then, you can incentivize or just make the input for him easier to justify for himself.
Yeah.
I actually look extremely critical by now onto advisors that that are not also investors. So, like, why would you want to spend a lot of time with that startup if you don't truly believe in the case?
Yeah.
There's also, I think, too many coaches out there by now. So you should look very critically, and especially if they did not have startup experience before. Yeah. So Alex was not like that at all. So he became a coach or an advisor before he invested, but he was also keen to invest in the first round, and he was really helpful. But now I don't do any kind of advisory or coaching if I don't put down money. And usually if I calculate myself, if I put down money and if I can bring value and if I can help them raise the next round, then I think
that's a good deal.
I have my value back, and I don't need to create a hassle for the startup to set up an agreement and create phantom stock. Only in very few cases, actually just one single one that I'm looking at right now, where I could from my profile perfectly fill like the gap that they have in the team. I would consider spending set amount of hours per week and a decent onboarding phase, maybe even, a part-time work relationship or part-time founder agreement for a temporary one, where I would want an agreement on top of the investment that I did.
But I like that. I fully agree. I think the only two ways to get shares of a company is either you work full-time in the company as a founder or whatever, or you invest in it. That's it. You shouldn't get any, so to speak, free shares as a consultant or advisor. Let's look at 2021. That was a pretty big year for you. You were acquired by Nautilus, which is now called BowFlex. Did they approach you, or did you approach them in your initial outreach for your new use case?
No, as Joel mentioned, we made tons of outreaches to all those different companies, and then we figured out home fitness equipment players like us, use us differentiator in the industry, see us as a growth market. So we worked actually with BowFlex at the time of the exit, I think around a year. We worked with various other players, their direct competitors. So it was very easy to get projects started with them, to sell them the subscription. And then, do you want to go into the exit story?
Yes, exactly.
So actually it started different. But so when we got all this traction, some funding thereafter, and we didn't really use the money, to be honest, because we had enough revenues to cover all the salaries. we very early on got, I think, was a connection request. That was the day we hired Emily. You remember that?
Was it?
You remember in the evening? No?
Yeah.
You were sitting there?
Yeah.
Okay. Yeah, we got, or Joel, I think, got a connection request from the chief strategy from, the biggest player in the industry at that time. And we were in talks really, like probably say 7-8 business development calls all day. So it was really a busy time. Again, when this connection requests, and if you know what responsibilities, what people have in organizations, those do the M&A deals. So we were able to quickly connect that. And then there was, I think, meaningless message that they want to have a call. And then it went pretty quickly to a first offer.
Mm-hmm.
Really, I think 2-3 calls. They looked at our technology team, and then we had an offer in our hand pretty fast.
So the thing was, I did not even make the connection. I was just like, we were reaching out to all the players in the field, but this was so far off number one that we wanted to like keep it for later. We wanted to get some experience working with the others until we approached them. All of a sudden, we get an inbound request from them. I did not make the connection like Ben did, that this was the chief of M&A, and we did the usual sales call. And I think directly after the very first sales call, we got an email saying, hey, we loved what you guys are doing. We love how you guys presented yourselves. We want to work together, but we don't want to license the technology. We want to buy the company. And that was 4 or 5 months after we almost needed to shut down, right?
Yeah.
And this was like, okay, what's
quite a roller coaster, right?
What the hell just happened?
Yeah.
Sorry.
How do you feel when this happened, when you got this email?
I mean,
you get goosebumps.
I get goosebumps now if I think back. No, that was, I mean, that was the roller coaster. I would say it was 3 months before. I mean, we had an investment there at that time, late 2020, that was secured by a Swiss VC. And then after term sheet signature, really before law sign off by IC, they pulled it away. And that really, I mean, it's, sorry for the language, but that fucked us.
Of course. You were calculating with that money, obviously.
And 3 months later, you got an offer, which was an okay amount. But then luckily we had advisors or investors, Dart, Doc, Griffin there. He went to various exits already. And I mean, also Sophie and Ariana was really able to give us some insights how to play this game. Everything is just a game there.
Then you really entered the negotiation process.
Yes. And of course, I mean, we both come from completely normal houses. The numbers you throw around there, I mean, in the millions is, you cannot really put that into perspective, or it's difficult at least to grasp that. For me, at least, it was kind of a game. Certainly we try to rationalize it and, calculate it down. What does it mean? And But then we, entered the game and negotiated a little bit. It was a little bit hilarious because we threw around high numbers. I know we have different numbers in our head, but, they offered first single-digit number, and we came back with, no, we want like 9 times that. Something like that. Yes,
it was absolutely crazy, just to be very honest. So you mentioned it was an okay offer, right? But
yes,
the very first offer they gave us before any negotiations was higher than any of the valuations we were discussing for the seed round with any of the VCs.
So that would have been a great result for everyone already.
So that was already very decent markup to what we were discussing in terms of valuation. On top, this is not a fantasy paper valuation, but this is cash in the bank, right?
Course.
So that makes it even much more real. So I think the first offer kind of both, at least me, completely knocked out of my shoes. And when Doug, and thank God for Doug and his experience and guiding us there and convincing us to go back with that insanely much bigger number, really a multiple of the first offer, I was resisting. I was like, dog, I'm not going to give them that number. They will walk away and never come back, and we'll never hear from them again.
You must have felt scared to lose the deal, right?
At some point, he convinced me. I gave them that talk, and I explained them in 10, 15 minutes why we would never even consider selling at that offer. And the day after, I got a very dry email where they had doubled the original offer.
Okay.
But they were still lowballing us.
Of course, of course.
So yeah, that was then double digits. It was already interesting. But then really we had ton of traction. We grew like, I don't know, 10, 20% MRR month by month. We actually had to think about it also. I mean, then, it sets in a little bit and we grow, and then you get positive feedback also from investors and so on. And not everybody was so excited actually about the early exit from the investors, at least of the 1, 2, 3 we had. I mean, certainly, but, some also were not like, wow. And then we worked again on the healthcare side very heavily as well. On the fitness side anyway, it was working well. And then we got also the first, I think, talks, at least with some players also from Europe here, which were leading in that technology. And then also from the number one, I think, company that leads this physical therapy market, remote therapy market in the US. This company still is growing like crazy, and they made us double a sweet deal almost of the improved offer. So we suddenly had like 2, 3 offers on the table.
Oh, that's when you go to play. Yeah.
We had those talks with other players as well that we were working with already. And then really before we wanted to sign, I think, the offer, or we
got close.
Didn't want to sign. Where did we go?
So what Ben said, right? Going back to that first offer, especially after it doubled, and us both realizing, okay, if we sign this and this deal goes through, we're going to be millionaires, not just on paper, but really with cash in the bank. And we were kind of like, wow. But at the same time, all of the signs were pointing up for properly up for months in a row for the first time. What I said before, all of those early successes along the way, along the first 2.5 years, all of a sudden were just white noise, because now everything was really pointing up. So we were good. We said, hey, do we really want to exit when for the very first time it's going so well? And I think that second offer that we got without asking for it from the healthcare side, that really started then the whole process of, okay, we should at least loot out where this could be going. And again, after we kind of finished the negotiations and we were able to see, okay, that first offer that we got, they would not move it more or increase it anymore. We were starting to negotiate with the second one, and Dog again said, now you have to communicate that you have this offer to your existing clients that could make an offer too. That was again very scary, because we were working with them and telling them, we might sell the company. I was scared that they would pull out and stop working with us, and we would lose our chance to really, really good revenue and big user numbers. But again, he was able to convince me, and we shared the word, and they were very quick to jump on the train and say, we really appreciate working with you guys. We could use a team like yours.
Was it also the healthcare player? Was it also with them that they, came in with the CEO and...
Yes. Yeah. I think in the end, within 2 weeks, we were really, all of them were US-based companies. Every evening, we would have 1 or 2 calls with their top-level management discussing where they could still move the needle up to make the best offer. And in the very end, I think the
time was running. I mean, that's important, sorry.
Yeah.
But if you receive an offer and they, immediately took Hamburger as their representatives in Switzerland. But when they give you an offer, that offer is running out because they have a timeline. They want to launch a product as well, and you have to fit somewhat in that timeline. So we were really in full negotiations with all those players, but the time was slowly running out. We had maybe 1 week left or something, and then we had those talks, and then suddenly we had to make, I think, a tough decision in the end to say no, that we don't want to take the offer.
And I think for us, we had to a fault, a radically transparent culture within our company. So with the team, there was somewhere around 12, 14 people by then. We shared that we have those offers, asking them just for extreme confidentiality to the outside. But we knew that we would also want to keep the team together, so they had to be on board as well. And I think in the end we went with Nautilus as we know today, and it was really that they were also extremely transparent with us. So they gave us and the team a very clear vision of where they see us within the company, what products they want us to work on. And all of the other deals were a bit more secretive, and you can't get to know all of the people on the other side. And Nautilus was very, very open and transparent, and they also made it very clear because we got them in at the very last minute, right? We were running out of time with the other deals, and we told them about it, and they were like, don't sign anything. We're going to make this our top priority. And our deal lead said, we appreciate you guys. We want to provide you with the best offer. Tell us what it's going to need from our side. And not only did he prepare the best offer, but also he painted this vision for the whole team. And all of a sudden, while our team had lots of questions about all of the other deals on the table, what happens to the team, who would they take on, Nautilus was like, we want everybody. This is what you're going to be working on. You're going to keep working also with ETH on research projects together with the AI Center. You're going to be our center of excellence all around new technology and AI. And yeah, that really moved the needle for us because we saw the team feels extremely good about this too.
Yeah. I feel that's a mistake that companies often make when they acquire another company. They don't understand the position or the viewpoint of the whole team that they acquire. And you have to make that work to be able to pull it off. Yep. He then reportedly sold the company for $27 million US. Is that roughly accurate?
Yeah, that's what is publicly available, I guess. In the end, the offer was even higher if you consider the stock option that we and the team got. Yeah.
Some escrow, etc.
Fair. What did that mean for you personally? Because you said you were becoming millionaires, but what did that mean for you personally, for both of you as founders?
Again, we both don't come from money, so it's life-changing. It's definitely life-changing. Now, I wouldn't say it's life-changing because if you look at me, I walk around exactly, probably in the same old clothes even that I had 3 years ago already. So yeah, in the first moment, it's hard to grasp. If money means something to you, maybe it really changes a lot of things. But for us, I didn't think it changed too much. Certainly, there is now almost absolute freedom in how we want to spend our time. That's super nice. And we can really give back some of that with bigger impact on the startup ecosystem. That's what we're trying to do at least. Yeah, but other than that, really not too many things changed. We still worked with the same people. We still liked our job most of the time, at least. Yeah, certainly. You think different about numbers and you're able to help your family a little bit. You know, all those things are nice. But in the end,
not much changed.
Not much changed. Yeah.
Cheryl, how did you celebrate the exit when you signed and the money has been wired to your account in that sense?
Very, very similar than how we usually celebrated with the team. So I think we had with our team a very celebratory culture also. We celebrated all of the wins together. We put in the hours when needed, when things were not going so well together. I think rather it wasn't a huge celebration. We actually did it the day before the closing. That was our deal lead's idea, who came over here.
That was risky.
Yeah, that
pretty
was,
risky.
I mean, in my opinion, it was risky. You didn't feel like, but yeah.
We went out for dinner and then ended up at Langstrasse for a couple of more drinks. And,
in Ole Ole.
And obviously our deal lead, Chris, he said, guys, whatever your plans are tonight, I will not accept you not coming to dinner. Everything's paid by Nautilus. And just to give you an idea how our people still worked, I remember one of our team wanted to order a glass of Prosecco, and then they told her there's only champagne. And she was coming to us like, you guys, it's okay if I order champagne, on the bill of the company. We're like, yeah,
that's the spirit. Yeah,
we feel like it's okay, and we had a great time. And the lead, who's 25 years older than the average of our team was, he celebrated with us, and that was about it. And after closing, we pretty much continued in the same spirit as before with the Zurich team. We had a couple of additional celebrations, I think, along the road
that we tried.
Yeah.
And some did, but our really closing party actually fell into
COVID.
Yeah.
Oh yeah, of course it was that time.
Yeah, we
New
planned
COVID,
it, but then it didn't work. That was sad. But
that's sad, yeah.
We celebrated enough, I think.
I'm sure you did. Ben, what was the traction roughly of the company at the point of the exit? Like how many customers, or what was the monthly revenue?
It was, at the very least, it was going up extremely steeply. So I think you try to create some FOMO, right, with investors. So I remember, because we had to focus a whole lot of the deal, but there was still the chance for a very long time that it would not go through, right? And then we wanted to use the momentum to close, to see a proper seed round, a bigger one than we already did. And on those pitch decks, you really saw MRR growing almost linearly over the first or over the last 7-8 months. And if we would continue like that, we would have 100,000 MRR by the end of the year. I think we were roughly at 50,000-60,000 MRR already, which at 100,000 MRR, you have 1.2 million in ARR. That makes you ready for a Series A. So raising the seed round with investors, we were really able to create that, okay, we need to invest now, because if they continue growing like this, and if one of the big clients goes live, all of a sudden that might double again, right? Because everybody was still in actually our non-commercial license where they already paid us, but they were not allowed to actually ship it. They were all still in beta tests. If they would ship it and really get their users hooked to it, all of a sudden that could double or triple, of course. So I think we were at around 50,000-60,000 MRR. We still had some project revenue. And yeah, as we said, we had a team of 14 at the exit. We were definitely not paying over market average. And we had everybody take actually almost 50% in phantom stock.
Nice. So all of them participate in the exit success in that sense.
Yeah.
Great.
And obviously that was a big risk for everyone coming back to that point 9-10 months before, where we almost had to shut the doors, and they worked for half of what they had if the phantom stock does not convert. In the end, it was luckily a success really for everybody. So the phantom stock 50% was worth much more. And yeah, but we were definitely cash flow positive in 2021.
Which is a great state to be.
That was a perfect state to be.
Cool. Let's also talk about the post-merger integration, because that can be a big challenge, especially if you're dealing with an American company that is also publicly traded. At one point, you told me that when we once met, Ben, at one point, the total market cap of your acquiring company was actually below what they paid you. Yeah. This is pretty crazy. So the money that they paid you in cash, you could have bought the whole company.
Yeah, we were thinking about that. No, I mean, yes, we were, but
That's a pretty
I think
drastic
it's
change.
important, yes, and really we were not well enough educated at this time, I think, as well. We made some learnings, definitely, also investment learnings when it comes to public market. And really you have to understand how the home fitness equipment game or market business works. And then I think it's pretty easy to understand why we were trading at this valuation, basically bankruptcy valuation. And in the end, now we probably can easily go into it. It also led to that Chapter 11 bankruptcy. The business, in the end, only the assets were sold for also around this valuation. Extremely good deal for the buyer from Taiwan. And yeah, certainly not what we all would have expected, I think, at the time of the exit in 2021, when everything looked very shiny, very steep. I mean, at the time they offered us, this money. The company, I think, was valued around 2 billion, something like that. 1 billion?
Nautilus?
Yeah.
I think 500-600 million.
At the peak, they were like 2
at
billion.
the peak, yes.
So there was a short time when the stock, I think, was trading around 33, something like that. Yeah. And in the end, what you're talking about, that was like 50 cents, something like that.
That's just crazy.
But also other players that are publicly traded made the same. The chart looks very similar. And that's really just in the nature of the business. You have to understand it. Again, everybody's at home. Nobody can go to the gym. Everybody wants home fitness equipment. Yes. And in the US, you have a little bit more bigger apartments or garages where you can easily store that thing. So everybody orders, margins go up, shipping costs were also up. So costs go up, but margins go up even higher. So they have a lot of cash in the at hand to spend for new innovations like ours. Makes sense. And nobody knew how long COVID would go, right?
Of course.
So when there was an end in sight, there was the shots available that helped us to, keep it in boundaries somewhat, COVID, then end was more or less inside, and everybody could understand, okay, this ends someday, and then what happens next? Because you have to pre-order. And so if you pre-order and the cash comes then in at this rate with nicer margins, that's cool. But what happens if suddenly the demand goes away? You will not get rid of your fitness equipment for the same margins anymore. Your margins will be depressed. We worked in B2B and D2C basically. And the distributors, so imagine a bigger Ochsnersport or we also work with Decathlon, they suddenly don't order from you. And that's like 50% of our business. So that goes away from your revenue. And then they also slash their prices because also their warehouses are full and they want to get rid of it because they need the space. So they slash the prices. Nobody buys from you anymore, basically, because they get it cheaper at the retailer even. So it's really a evil cycle downwards that then leads to really margins that you cannot finance your business with. And then you write like 100 million loss a year, and that you can do 1 year, certainly, maybe 2 years, but in 3 years, your company's worth zero.
Of course.
So look at the balance sheet.
Makes a lot of sense. It seems from the outside, you got the timing perfectly right? You got a nice exit. You got a very good price in that sense. But now you had to also liquidate the Nautilus Switzerland company, let go of the employees that were very important for you to keep. How does that make you feel as founders? Because I see both perspectives, right? You can be very proud of what you achieved with the team and the great exit you had, but at the same time, it's also a shame out of your control that this happened.
Yeah. So timing wise, on the fitness side, 100%. I think we started the talks or the negotiations at the peak, and we closed within 6 months after the peak. And quite clearly, even 1 year later, we would, from fitness side, not have gotten any deal similar to what we had. we lost physical therapy and rehabilitation side, right? And I think we still feel a bit sad about that. And we still see this space going extremely strong. So definitely we would have had decent options to move more into that space. And we had roughly 50% of the business already there. Yeah, now I think if you look at the home fitness market, it was always extremely cyclical. So even if you look at the Nautilus stock over the last 40 years, it was always the same. Yeah. I think after COVID was an anomaly, an extremely high peak, but that also made the recovery after longer. And I think that was the miscalculation that happened there. And just looking at the market, I think Nautilus actually acted more defensively, made less big mistakes than the competition, but we were a publicly traded company, and there is some craziness in public markets, and we were not able to raise the money to go through that low point, through that Talsohle, and make it out on the other side. We still believe for all the competition that manages to keep going, there's going to be an upside in a year or two or whenever. Nautilus didn't manage to raise the money. We were looking over a year for also a strategic partnership where that could range from a merger with one of the main competitors to being a full acquisition to maybe a joint venture or anything. I still think this should have been possible to find, and we were, from what I understand, but we were never fully let in. We were very close to closing such an acquisition or major investment by that same company that then eventually got the assets from the bank, from the Chapter 11 process. Unfortunately, we didn't manage. So we ran out of money. We needed to go into that. The Swiss company, despite also having other plans originally of continuing sale of the software, for example, to create revenue. When things get tough, focus gets more important, right? So we needed to shut down a lot of that to really focus on delivering just great software and also digitize our company and revolutionize like the way we develop software with smaller teams with much higher efficiency. So our focus was completely inward, and the Swiss company's only source of money was the US company. Yeah. So when they go into the bankruptcy process, the money couldn't flow anymore. So luckily, we continued to have this very transparent culture. Luckily, we continued with much of the same team. That was a sworn-in group of people that also consider each other friends. And we always told them, look, let's stick through it. We don't know what's going to happen. We honestly don't, but I made them the promise. I'm going to be the last one to leave this ship if it's actually sinking, or maybe we can all push through and get out better on the other side. And they understood that. They knew what's going to happen. So for all of us, it wasn't necessarily a surprise in the end. And also, that being said, the last 12 months before the bankruptcy were not our the most fun times. So we were the digital natives. We were the software brain of the company, and we tried from Switzerland to change the way we develop software across the whole organization. That was big Sisyphus work of constantly pushing at closed doors and pushing at walls even, and nobody was like extremely sad to not continue this constant fight anymore. Of course, we would have wished for an orderly shutdown of fading the team out, paying all of the salaries, but there's luckily zero grudge from anyone. So I think during that last weeks and after, we regularly had not after work beers anymore, but just sat together and continued to meet as friends. And of course, I believe all of our team are extreme startup guys. So I tried actively to place them in new startups where both Ben and I have the network. We spread the word that we have great engineers that are available. I'm trying to push some to also become founders. So yeah, my biggest task actually for the 2 or 3 months right after was trying to support all of the people to figure out also where do they apply for insolvency reimbursement and stuff, and help them figure out what they could do next, make them introductions and so on.
Great. Thank you for sharing that so openly. I really appreciate it. One thing we often hear from founders who not only sell the company, but now what you also went through, basically had to shut down the company that acquired you as well, that they fall sort of in a post-exit depression. They don't know what to tackle next or what to do next because a big chunk of their lives, the own company that they built up, is sort of gone. How did you navigate that? Did you experience something similar, or did you find a new calling with the startup investments that you're doing these days?
By now, I definitely did. But for me, at least, at the time, even after the exit, so during our still, let's say, period with the buying company, with Nautilus or BowFlex, already there, for me, the day-to-day work was extremely different. For me, it was worse. I liked it. Really, 2021 was still, to date, probably my favorite year. Mm-hmm. So I think just founders have to really consider what happens in an exit, and that you, in the normal case, usually have to stick around like 3 years or something, except if you exit to PE and they want to replace you within, I don't know, months. But usually you stick around, you have to stick around with your team, and you're not calling the shots anymore. I mean, I didn't really before. I mean, we did it together, but then really you have so many naysayers just because of culture or different focus, that work also changes mostly, I think. For the business people, certainly. And now, honestly, again, what Joel said, we focus now, that was for me at least a little bit more intense again with the team, that everybody is more or less set and finds a new job, and they get all their money and so on. And yeah, startups can keep you very easily busy, you know that yourself. Yeah,
I think for me, this post-exit depression was probably shifted 2.5 years. So, I mean, I really pretty much kept some of my roles in the new company. I was still responsible for the same team in Switzerland. Then moving on in the company, I took over all of digital product leadership. So I was in charge of the digital product strategy and vision. And I still ran 120% and put in much more hours than I think anybody in the US ever would have expected. And I think they also looked at me a bit like an annoyance sometimes because I wanted so much, but I was still able to give a lot of passion into this whole work. Now, I think end of last year, beginning of this year, when things just wouldn't move. So I was still working so hard, but things wouldn't move. I think I almost ran a bit into a burnout, although working much less, but just the success wasn't there. I put a lot in, but I got very little back. So that was for sure a hard time. But I think the real post-exit depression happened now those past few months, where all of a sudden everything was gone. And took a very deliberate decision in March, April, May, that I would not do what I always have done, to jump on the next thing and pursue the next goal. So I wanted to give myself some time, but I probably did not expect how hard it would be on me. So I definitely did not have the best summer of my life. Although, if you kind of look at it from the outside, I have a lot of free time. I have enough money to do whatever I want. But still, mentally, it was and still is pretty hard. So, yeah. still spending more time with the startups I'm invested in makes a lot of fun. I love that. So I'm trying to give myself into new projects and look for the next full-time thing or big ambitious projects for myself without any rush, so to say.
Yeah, I feel, first of all, thank you again for sharing that, because I think it's so important that people also hear that side of the story. From the outside, it always looks like you had a great exit, life is perfect, but no, it's not, because that's the real struggle. If you had to find words to describe what's missing, in exactly that moment that made your summer challenging and difficult, what would you say? Is it the meaning? Is it the reward? Is it the people? What would you say is the thing that is missing the most?
Just that my life functions completely different all of a sudden than ever before. So, I mean, I had my sports career, I had high school and then university. I always had big goals, and I rarely took the time to really chill and enjoy having reached a goal. I set the next higher one. And I think right now, and in April, I thought it would probably not be too healthy to set an even higher one next. So let's take this a bit more carefully. But all of a sudden, my life worked very differently. I did not have this North Star that I could run after. And I think one of my friends I talked to during August, during the Olympic Games, he mentioned something that actually a lot of Olympic winners have, this other side of the gold medal. So you work as an Olympic sportsman, you work your whole life towards that goal, and all of a sudden you reach it, and now what's next? And
selling a company.
I could relate very well to that analogy, honestly.
Yeah. It's sort of, would you say it's fair to say it's like the meaning that gets lost a bit there?
What's meaning, right?
Yeah.
But just not have this
the thing to chase.
If you always set ambitious goals, you kind of always feel like you're never going to reach them anyway. And all of a sudden you have reached them. And then either you can set the next goal and continue in the same that it was before, or really your life changes quite a bit, and you have to first process what this means for you and figure out maybe you don't have to set a higher goal, but go in some completely different context.
Yeah, absolutely. What I really admire from both of you is that you not only made the exit happen, but you also give back. You invest in the next generation of entrepreneurs. I think that's really important from an ecosystem perspective. So thank you both for doing that. I think you're really great role models in that sense. So looking into the future a bit, what is next for you? Let's start with you, Ben. What are your plans? What is next for you?
Nothing is set in stone, but I think I see myself very well as an investor in this ecosystem that we have here. That's still not where it should be. There's too much potential, especially from the technology sector. And I think also Switzerland, Europe needs young, cool investors like us that support startups, in a different way than maybe previous investors did it. Yeah, so I'm probably going to stick on that side, but also very open for any other ideas. Yeah, so
great.
As Joel, I'm still also, I don't want to rush. I want to take the next decision, the next step, very deliberate and be sure about it. Yeah.
I mean, I'm an active angel investor. The first 1.5 years, I definitely did too many. So now I think, as I heard a lot of exited founders do, now I'm much more selective. I'm LP in four venture capital funds. I don't think I don't see myself working as a VC. I mean, I think to me that would be torture, getting so many great ideas across my table, being able to invest in just a very few of them. And then I think at some point, probably within the first year, somebody would get an idea on my table that I would be like, oh shit, I want to actually work on that. So rather, I do see myself, because looking back, I enjoyed that so much, building a product from scratch, building a culture from scratch, building up that that sworn-in group of people that follows a big, ambitious vision. But we are rooted in the ecosystem. We think there's still a lot to do in the ecosystem. So I'm still also working out an initiative how we could just push more money in the ecosystem from the investment side. So basically get more money into VCs so they could fund more startups, because I think we do have huge funding gap towards rest of Europe and especially towards the US. I think if you look at our top-notch research, especially from ETH, and how much is invested in commercialization, we're also very far behind. So that would be very dear to me. And if I find like in my niche to support getting more money into the system, I would do that. But very generally, I probably see myself doing another startup eventually.
Amazing. Exciting times. Let's wrap up with some rapid fire questions for both of you. I start with you, Joel. Did you watch the volleyball games at the Olympics?
Yes. So actually I went to Paris to watch some beach volleyball games in this amazing location right underneath the Eiffel Tower. That was just stunning. And then I did watch a lot of men's volleyball, and I discuss with my friends a lot, also with the ones that still play in the national team. So right now they're also just doing qualification for the next European Championships. They qualified for the first time last year, right after I left. That was a bit unfortunate. But the men's indoor volleyball level was incredibly high. Like we saw so many very close and really high level games. It was fantastic to watch.
Amazing. If you had just one sentence, Ben, what's your favorite thing about being an angel investor?
Learning about new projects, new technologies, and new perspectives.
Nice. And Joel, would you ever build a startup again? You said yes before. In what space?
Very open. I recently read a study that you should keep close to your original business model and close to your market that you've been in. Then you are a multiple more successful. But if you get a bit arrogant because you've done the startup journey once and you completely switch market and business model, you are actually not more likely to succeed than a first-time founder. So looking at the statistics, I should likely stay close to where we have been. And I still feel very passionate, especially about health tech.
Nice. What about you, Ben? Would you ever start a new company again?
Yeah, definitely. I mean, there are different things to consider, obviously, and the pro arguments for that are clearly the ones that you all mentioned. Same for me. Definitely tech. I mean, that's what a startup is. But I'm also very open. I just like the business of the business.
It's like a cool
from
game.
A business perspective, actually.
If I call, will you join?
Sure.
We heard that. We have that on the record. Amazing. So let's do a few quick ones. What does money mean to you?
I think freedom. But what Ben said before, I think especially holds true for me as well. I have not changed a whole lot in my life. I truly enjoy giving back, and I truly enjoy funding great ideas and passionate people. So this freedom to invest in projects, and right now not having the need to look for a job, that's really freedom. So
investor or founder, Ben?
Still founder.
Sports or business?
Right now it's more sports.
Fair. And I just wondered, for both of you, how happy would you rate yourself at the moment, from 0, very unhappy, to 10, very happy?
As I said, I had some struggles this summer, so definitely couldn't place a very high number now about how everything went down with our startup. I would put a straight 10. Right now, no, I'm at the 10, but right now I couldn't place it.
Okay. For you, Ben, if you had to choose a number?
Now?
Yeah.
7, 8.
Okay.
8. I had a great summer, but again, I was also happiest during our startup times. Yeah, and then that can fluctuate.
Were you happier before or after the exit?
Within 2021, let's say.
Okay.
So that includes both the time right before the exit when everything, those months leading up to the exit, and then finally putting the signature and all of the high pressure falling off, and few weeks after, even though we were not like celebrating like crazy, but just continued working. But those were the greatest time where I think happiness was a straight 10.
Yeah.
It's a difficult question because honestly, during that time, I was totally stressed out.
Yeah.
I broke up with my girlfriend, I would also say as a result of the stress. So probably back then I would not have answered I'm the happiest right now. But if I look back now, that changes. And so in the end, probably it would be fair to answer that question in 3 years and also for now.
We'll do another podcast episode in 3 years.
Okay.
Done deal. We
Good.
just look for a date now.
Sounds good.
Guys, that was a fantastic episode. Thank you both so much for coming on the show and for being so open. I really appreciate it, and I hope that you motivate and inspire many others to pursue the path of entrepreneurship. Ben, Joel, thank you so much, and all the best wishes for the future.
Thank you. And I think we hope exactly the same. And thank you for the work that you're doing for the Swiss ecosystem. It's really fantastic to know you actually for almost as long since when we started, and went to Las Vegas together and even before. And I think you're writing a great and really important story with Swisspreneur for our current and future entrepreneurs.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.